Hello, everybody, and welcome to VRIC Media, your most trusted voice in metals and mining. My name is Jesse Day. We are bringing the VRIC to you. Today is November 18th, 2025, and we are doing a panel on my favorite commodity. That is uranium. Of course, we need to bring the dynamic duo back for that. We've got Justin Huhn, publisher of the Uranium Insider newsletter, and Mike Alkin, Chief Investment Officer at Sachem Cove, a uranium-focused fund. Gentlemen, it is so great to have you back on the show to talk uranium.
Thanks for having me again, Jesse.
Yeah, thanks, Jesse. Always fun to come back and speak with you guys.
And I'm very much looking forward to it. I want to kick things off by talking about the uranium market so far here in 2025, because the last time we had a conversation was actually at the start of the year. Here we are getting close to the end. A very interesting year for both the uranium market and nuclear energy. So I'd like to ask a bit of a year in review. What went according to your expectations? What, if anything, surprised you? And what is your overall assessment of the uranium market as we sit here today, Justin?
Wow, I can't believe that we haven't spoken since the beginning of the year. Has anything really happened though? I mean, it's been kind of quiet. It's been just like owning just like a stable blue chip dividend stock and just kind of riding the subtle waves, right? No, it's been an extremely tumultuous year, especially for the equities. Since we've spoken, we had an absolute gut punch March into April. The sector sold off extremely hard. Terrible, terrible sentiment. The market recovered and then some since then. What happened to our expectations? I would say that we did expect to see the term price finally move this year, and we're starting to see that. We're kind of in month three. I think we'll probably see maybe another uptick this month, probably another couple of bucks move up before the year is out. We didn't know exactly when that would happen. It was pretty clear that wasn't going to happen in the first couple of quarters, but that did start to pan out. So now we've seen the term price up $5 if you average the two main price reporters in the last 2 months, and that's very good to see. We did expect to see some kind of support for nuclear from the Trump administration. We didn't know exactly when that would hit or what it would look like, but that's been beyond what we expected to see the direct investment in Westinghouse, to see Secretary Chris Wright basically saying that the majority of the funds from the loan program from the DOE is going to go towards building new nuclear. I mean, things like this coming from the Trump admin have been huge. What we didn't expect, well, we didn't expect to see the trough so steep back in April. We didn't expect to see such a sharp V-shaped recovery and to see the equities go so much further. We didn't expect to see Sprott come in and do a $200 million private placement, only to raise in the open market another 475 million in the last 3.5 months, 2.5 months. Most of that has gone towards buying uranium. They still have a little bit of cash here. So we've seen a lot of new investment interest flow into the space that wasn't necessarily expected, especially with how the sector started out the year. So even now, we've seen the equities up substantially. The spot price is barely up on the year. URNM is still up 30% after falling 22% in the last few weeks. So it's been a great year for the equities overall. But yeah, those are a couple of things I did and did not expect for the year.
And then what about as we sit here today and look forward to 2026? How are you viewing the current health of the sector?
It's a very complicated sector. I would say that seeing the term price starting to tick up, and we're seeing what we want to see in the physical market. I'm sure that both Mike and I can dive into this at some point in this chat, but we're seeing a little bit of utility action. Finally, utilities, generally speaking, have minimal levers to pull to avoid paying these higher prices that the legacy producers are wanting, and we still have that in front of us. So basically, all of the constructive things that we've seen in the physical market across the fuel cycle over the past few years have generally speaking all been utilities covering conversion and enrichment and doing everything they can to avoid signing these big contracts at higher prices. So that, in my opinion, is ultimately unavoidable. Exactly when we tip into that realm is harder to say, but I think it happens next year when we start to see larger contracts signed with these larger legacy producers, significantly higher prices. That's what we have in front of us. In the meantime, we've got some market volatility. We've got Nvidia earnings tomorrow as we're recording this, so who knows what that's going to do to the broad market. Plenty of uncertainty around all of that. But everything looks really, really constructive on the uranium side. The demand is just so de-risked here, and it's just a matter of time before we see much more volume in the term market, much higher prices.
And Mike, your thoughts on the uranium market in 2025? What surprised you, if anything, and how do you think we're positioned heading into the new year?
Yeah, so I think, Jesse, looking at the term market, which is where we spend a lot of our attention, the contract market, which is where, 80% of pounds transact. You've seen it's really been a few interesting years because you had one of the things we talk about a lot is the replacement rate and how many pounds are utilities buying because they're the only customer for the most part. How many pounds are they contracting for in the long-term market each year to replace what they've consumed? And over the last decade or so, that's been only about 45%. And so if you're not replacing all the pounds you consume, what you're doing is drawing down your inventories. And the inventories, whether you look in Western Europe or you look in the United States, North America, and you look around the world, those are at or below historical levels, certainly below where utilities should be comfortable. And what we've seen, though, is you started to see that spike up in 23, where utilities took that up. Let's say the number back then used consensus demand numbers. We're a little bit higher than that, but let's say at that time it was 180 million pounds. You saw them contract at around 160 million pounds, and the price of uranium was sitting around in the long-term contract market around $68. And that was an increase in 23 from what had been 100 million pounds and then 70 million pounds. So it wasn't quite at replacement rate, but the trajectory was getting there. Now, if you think back, 23 was the year after the war started between Russia and Ukraine. So utilities were a little bit nervous. They were focusing more on the downstream, which is the enrichment and the conversion, as Justin alluded to. That's where there's much more of a concentration of suppliers, and Russia has much more control in the enrichment and conversion market. So you saw a lot of contracting taking place there, as well as in the uranium market. Now, fast forward to 2024, the price of uranium or the contracting went down to 110 million pounds from 164 million pounds. But the price went from $68 to $81 a pound. Now start to think about being a commodity investor. When volumes go down, you typically don't see pricing moving higher. Now let's fast forward to this year. Contracting as of last night, when UxC reported their latest update to their weekly contracting tally, it went from 53 to 63 million pounds. So a nice jump, but still far below on an annualized basis what even last year was. But the price in the term market, the fixed price contract, is now around $85, $86. If you look at TradeTech's reporting at UxC's 84, but midpoint around 85. So again, volume's down precipitously, yet pricing keeps going up. So it was 68 when they were contracting 160 million pounds in 23, price was $68. Now it's almost $20 higher just in the fixed portion of that on volumes that are down. Now, why are the volumes down? From to my mind and to the analysis we do and the conversations we have, it's for one reason: the utilities really don't like paying that price. They're mad. They don't want to pay that price. Not so much they're busy with you enrichment and conversion contracting. That ship sailed. They did that. They are angry that they could have paid $25 or $30 a pound, and now they're paying 4 times that, and they're going to pay a lot more than that, all because they refused and were stubborn and refused to look at the supply-demand situation going out into the past. Rather, they chose to anchor to a recency bias of the prior several years where there was an abundance of uranium. And that's just human nature. Anchoring recency biases, well, you know what? They can get you run over if you don't lift the anchor up. And that's kind of where we're at right now. So they're doing everything they can. I did an interview recently, and I said they're trying to break the union, if you will. They're trying to stay out of the market, and it ain't working because prices are going higher. And that price I mentioned of 85, that's, for those who don't know, I'm sure many do, but that's the fixed price contract. That's where only about 30% of the pounds in the long-term contract market trade. The rest of it right now are trading in a market-related component, which means at the time of delivery, sometime in the future, at least 3 years into the future, and many times 5, 7, 10, 12, it will be based on spot price in the future. And they put some floors and ceilings to collar it, to give comfort to both sides. But those prices now, I mean, are in the 120s, 130s, sometimes 140s on the ceilings, and the floors are 70, 75 when the spot price is 76. So the asymmetry for sellers of uranium, producers of uranium, is so dramatically in their favor versus the buyers of uranium. So as much as utilities are protesting, as much as utilities are trying to stay out of the market, and you talk about a stretched rubber band, inventories around the world are as low as they've been in decades. So they are flirting with a real problem. So all of that said, when we look at nothing from our perspective, from a supply demand standpoint, has changed. Our thesis has been whether or not there were SMRs, whether small modular reactors, whether or not AI and data centers ever became a thing. The reality is, prior to all of that, there is a structural supply deficit, meaning when you go to contract at 100% of your consumption, what happens? There's not enough of it. And if you don't believe us, look at the World Nuclear Association. I've been out, and Justin's been out jumping around for years saying there's a structural deficit, folks. Prices have risen 4x. That kind of makes sense, right? The World Nuclear Association, the largest governing trade body that represents the interests of all those in the industry, have just come out recently in their September report, their biannual report. Every 2 years, they put out a report that shows a cumulative deficit of 1.1 billion pounds through 2040, or 70 million pounds a year. So that is how many pounds are produced and how many pounds are consumed. Will reactors get shut down? Very likely not. Where will it come from? Inventories somewhere. There are above ground inventories, but inventories in a shortage are very dear, and there's a price associated with that. And that's what this market, I've looked at markets for 30 years as a professional investor, that what this market tends to ignore, the buyers of this commodity tend to ignore that the market sets the price. And the inventories will set the price, and inventories have a price associated with it. Somehow, they think the inventory fairy appears with uranium, and so that's kind of how we're thinking about it. The volatility in the equities has been breathtaking at times, as Justin alluded to earlier. But but that's narrative, right? That's people, that's headlines, that's narrative, that's algos trading. It's people chasing after a move of up 50%, and then all of a sudden it goes down 20 and they panic and sell. Can't do anything about that. We just try and ride it out.
Timing's everything in this business. We've seen commodity prices really move up. The copper price, that's started to move up strongly. We're not far off all-time highs, although you wouldn't know it from the junior sector and copper companies in general. But I think over the next year or two, we're going to see that really correct to the upside, and you're going to see a lot of money come into the sectors. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. If you want to learn more, you can find us at vizslacopper.com.
Great summary from both of you. One big story that has come out of 2025 is the Trump administration's push to expand nuclear energy generation in the U.S., along with trying to incentivize domestic production of uranium, now officially declared a critical mineral. How much of an impact do you think these policies have had so far, and how effective do you think this administration will be in accomplishing their stated objectives? Is this something that's going to provide major tailwinds behind the uranium sector in America? Is it more hype? Is it more noise and signal? Would love to get your thoughts. Justin, I'll start with you.
It's hard to say. I think what's definitely evident is that the administration is taking it seriously. And I think that that's caught the attention of the industry. So I think that if we actually do see shovels hit the ground in the next 24 to 36 months, that's going to have a meaningful effect in multiple ways. I think that's going to actually have influence over the Western world in terms of, we can build new nuclear again. And secondly, if we actually see construction start in the next couple of years, we could see first criticality in the middle of the next decade, which means we actually see some fuel demand 5, 6, 7 years out from now, which happened. That sounds like it's a long ways away, and it's really not. This is the period of time that utilities will need to cover, and will need to cover relatively aggressively in the next 24 months. So if the utilities have to step in and cover off 2031, 2, 3, 4 in the next 24 months, and they're going to have to do so in competition with fuel demand for new reactors that nobody was budgeting for in their models, that's going to create some competition. It's going to create some price discovery. So this could actually have a meaningful effect as far as how we model the sector. Seeing support from the US, to speak generally, really has only meant we can factor in a couple of restarts or a few restarts, right? 3 Mile Island, Palisades, Duane Arnold, and now it's looking like they're going to restart the construction of VC Summer. So all of those we can potentially model in, and some of them we definitely can model in. Everything else is just a de-risked operation of the existing fleet. So life extensions across the board in the United States. The last one that's remaining really is Diablo Canyon. Even though it's already been approved by the NRC, there's still the California Coastal Commission, some bureaucracy stuff happening here. It's probably going to get life extended beyond 29 and 30 for those 2 units. So it's, for us, as far as modeling for uranium demand goes, fantastic for de-risking demand and life extensions across the board. As far as what this means for new uranium demand from new builds, that remains to be seen. With that said, it's clear the administration is very, very supportive, very serious about this electricity demand scenario. We're already seeing reverberations in the market, rising electricity prices, especially in the states that are operating a lot of data centers. They're taking it seriously. I think that the industry is paying attention. The nuclear industry is paying attention to this for sure.
And Mike, would love to get your thoughts as well, and perhaps any comments you might have about the actual possibility of these reactor buildouts happening in a timely fashion. We've seen huge delays, things being very over budget in the past, and the nuclear industry in the US is widely considered to be extraordinarily over-regulated, very difficult to get things done and cut through the red tape. So what are your thoughts there? Do you think they will manage to get things done?
Sure. I don't know. It's a good question, Jesse. What I would say is I always take the under when it comes to the nuclear and uranium industry. I continue to be unimpressed by the ability to get things done, whether it's producing a pound of uranium or whether it's fuel buyers recognizing shortages, or it seems to be an industry that has a hard time shaking a 30-year legacy of a defeatist attitude. Now, from an investor standpoint, I'm fine, totally fine with that, because that creates the inefficiency, right? That creates the asymmetry. But when you see all this fanfare in the executive orders, and we're going to build this, and we're going to do that, and the hyperscalers, right? The Amazon, the AWSs, and the Googles and the Metas are all coming into the space, and they're going to work with the utilities. You ever sat down with a senior utility guy? That it's a defeatist attitude from a nuclear plant. They went through 30 years of hoping to get the kids through college before their plant shut down. There is not a lot of there in terms of excitement to get things going. Who's going to take the risk? Who's going to put the money up? So, the way I look at it, someday you're going to just, I don't know when it's going to be, but an Amazon or somebody's going to say, yeah, okay, we don't need you. We'll go get the plans from the Westinghouse. We'll build it ourselves. Right? We could do this. But if you are a uranium investor, none of that matters. There is a structural shortfall of uranium, as we just talked about, from a contracting standpoint, when they're contracting to replacement rate, whether or not an SMR ever gets built, or whether or not data center demand goes bananas, it doesn't need to. There has been, before you started 12, 18 months ago, the AI push and everyone getting excited about all of this and NVIDIA going nuts. The shortages were as far as the eye can see. This just makes it even worse. So in terms of the shortages. So do I think that SMRs will get built on time, on budget? Probably not. Do I think the new big build reactors will get done in a time period that is tied up in a bow with a cherry on top? And I'll no, probably not. Do I think there's more motivation to get it done? Probably. But from my thesis as a uranium upstream uranium investor, not an SMR investor, not a technology investor, not all the components playing downstream, I don't care about any of that. Our supply demand situation is already resolved. There ain't enough uranium, and it's too late for them to figure it out, and prices are going up. is kind of just how I think about that.
Yeah, very well said. And you alluded to it there, how difficult it is to get a pound out of the ground. This year has also shown many production woes across the sector, from the biggest players like Kazatomprom and Cameco to developers attempting to ramp up production like Encore and Boss, along with mine startups facing delays. We had a coup in Niger. I mean, the issues seem to be everywhere. Mining, obviously, a very tough business.
Hard.
How much have these issues set us behind on the supply side? And do you expect more of this in 2026? And this time, Mike, I'll start with you.
So that's a great question, Jesse. So you think about, the supply side, we think about the brownfields coming in, right? So I mentioned earlier that the WNA is a 70 million pound per year structural deficit. And then there will be some inventories that come in, but it's massive. We are in the many, many, many tens of millions of pounds per annum of structural deficit. So what you tend to see and what utilities love to do is they will go to these little brownfield startups doing, let's put this in context. So frame it for those of your listeners who aren't familiar. The biggest mines in the world, up in Canada, the Athabasca Basin that Cameco is running and operating is 18 million pounds a year. Big, right? So what you're talking about for context is some of these startups will come in at 500,000, a million and a half pounds a year. That are starting to come into production, and the utilities, and some of them are in developed countries like the U.S. Others are in developing Africa. You mentioned a coup earlier. There's some in other parts of the world, and what some of the shrewder fuel buyers will do is they'll go to a small development in project in Africa and throw 100 to 200,000 pound contract at them, so that they'll come in a little bit lower on price than where the marked price is, where the price reporters are going to market. So that serves as a way for them to go, ooh, look at that, we won, and the price report is going to turn their attention to that low price, and we're going to keep the bar set for that little bit, which is really a stupid thing to do, because at the end of the day, the 200,000 pounds to that utility mean nothing because they could get it elsewhere. They have it from inventory, but they're doing their best to try and set pricing down. But when we think about all of these total projects, if we look around what is supposed to come online, 6, 7, 8 million pounds, and maybe we've seen a few million pounds come online this year. Again, why? Because mining is hard. Brownfield is really hard. Restarting projects is hard. When you're doing in situ recovery mining, ISR, which to those who aren't familiar with it, it's if you drove over by the mine, you wouldn't know it. It looks they're putting injection wells down and recovery wells down. It's a very quiet operation, low cost up front, but ongoing high cost to do. But it's chemistry. So you've got to be able to get the chemistry right to be able to pull it back out of the ground, and it's hard. And the recovery is hard, and the depletion rates are significant, and they're like natural gas. They implode. So it's really hard. But at the end of the day, you're talking, if everything went perfect, you're talking 5, 6, 7, 8 million pounds that would have been produced this year in a market with many tens of millions of pounds of deficit. So that they produced a few million instead of the 5 million, it makes for headlines. It makes for, oh, geez, they didn't meet their production, but it doesn't solve a fuel buyer's problems. And I mentioned in a prior interview, I got to come up with a better term, but it is rearranging deck chairs on the Titanic. You're going down, you got a problem, and moving that deck chair so it's in better position doesn't mean anything. That's what fuel buyers are doing by throwing a couple 100,000 pounds out to some little producer somewhere. That's irrelevant. So what really needs to be done is much higher pricing from an incentive price standpoint to get these big bulking mines going and the ship sail. So that's why pricing, you think, will move much higher. But producing uranium at the big level, at the Kazatoproms, at the Camecos, even they're running into challenges. Cameco has had some challenges with one of the zones they're in. They had to reduce production. That matters. Kazatomprom, same thing. Is it sulfuric acid, or are they having challenges pulling it out of the ground? Did they bring out a lot higher grade earlier on in the mine lives than now? So high grading, and now that's a challenge. That's where you have real issues. So when the big boys are having problems, that should speak volumes.
And Justin, your thoughts on production woes the sector has faced in 2025 and whether you see them continuing into the new year?
Continuing to the new year is hard to say. We only got 6 weeks left, really, of the year, and we've got 4 weeks left of any meaningful kind of market activity. Hard to really say there. I think Cameco ultimately probably overcomes the challenges at MacArthur and Key. With all of that said, I think the biggest story that not a lot of people are paying attention to is just the pipeline of projects for the big producers and the capital costs that are being baked into the negotiating terms for the likes of Cameco, for example. So when you have utilities that are, as Mike mentioned, poking around these brownfield restarts and developing companies trying to get what they can at base escalated in the 80s, and then you have Cameco asking for majority market reference with ceilings at 120, 130, 140, it's a huge disjunct for utilities. And you could actually argue that utilities they can't pay these prices until they have to. And what I mean by that is I think it's important to kind of put yourself into the utilities position for a moment and think about signing a 10-year power purchase agreement offtake with an electricity consumer at a fixed price, and then going to procure fuel for that reactor that's going to be producing that electricity, and not knowing what you're going to pay for fuel, and having a 60-70% difference between the floors and the ceilings on that contract. It's sort of, from a budgetary perspective, an impossible task. With that said, and Mike, you mentioned this in an interview you did last week, they're not going to have a choice. This is what Cameco wants, and it's not because Cameco, and I'm using Cameco as an example, but they're not the only ones. It's Orano, it's Kazatomprom, the big boys. It's not that they're trying to turn the screws to the utilities. It's not that they're trying to be vengeful because of what happened to them in the previous decade with utilities having a free-for-all of cheap, abundant uranium and Cameco being left for dead. It's because they're looking at their pipeline. Cigar is done in 10 years. MacArthur is done in 15. That's a big problem for Cameco. It's a bigger problem for Orano. And these projects need to be replaced. And that's we're talking billions and billions and billions of dollars of development capital that's going to have to replace these pipeline projects. So those costs are being baked into these negotiating terms. And that's the thing that I think utilities really have to get their head around. As far as what we're looking at in terms of production woes, Kazatomprom, if you go and read their last CPR, their competent persons report, they're actually literally scripting in this report the huge capital needs that they're going to have to put into the ground in order to be able to produce about 20% less than they're producing now in 2035. So they're telling you, we've got a pipeline problem too. Yeah, we can get a little bit more out of exploration going out into the next decade, but we don't have another Kazatomprom on the heels of this Kazatomprom phase 1 that's been an enormous, huge production story over the last 15, 20 years. Like I said,
and by the way, Justin,
also
they've said
yeah,
that.
go ahead,
Yeah.
please.
No, I'm sorry to interrupt, but you're absolutely right. They have publicly said that. Riaz Rizvi, when he was the chief marketing officer 5 years ago, was saying, you need more Kazatoproms, and we're not out there. So it's like the answer key's been hiding in plain sight, but the utilities haven't listened. Sorry to interrupt you, Justin.
No, absolutely. You're absolutely right. Anytime, please. So this pipeline story is a big one, especially I think Orano. Not a lot of people are talking about that publicly. EDF, which is the state-owned nuclear operator, we're seeing new builds being announced. We're seeing life extensions there. The state-owned uranium miners is definitely got pipeline issues. Honestly, I think the big right tail event of the next few years is either development challenges for some of these large projects that absolutely have to come online, and or a pushing back of the timing of these projects producing. And of course, the big one is NextGen's Rook I, the Arrow deposit. If that isn't producing 29 million pounds a year starting in 2031, it's not going to be a shock to Mike or I, but it's going to be a huge shock to utilities. So we'll see how that pans out. But yeah, demand is unbelievably de-risked here. Production is a problem. Eventually, will high enough prices manifest and enough supply will come out of the woodwork and out of the ground? Yes, I think that it ultimately will pan out on a long enough time frame, as any commodity will. We don't know when that's going to happen, and we don't see any evidence that that's going to happen anytime soon.
Jesse, it's again, I go back to and Justin's been going to these for many years. We're fortunate in the sense that we've sat down with this cohort that buys this stuff and have been doing it for 8, 9 years, whatever it's been, to see the reluctance to commit, even though prices are up 4x. There is a reluctance to believe that they're up. There's a reluctance to believe that they're going higher. There's a reluctance to believe the challenges it takes to produce a pound of uranium. And what I find interesting is when these reactors are coming back online, and Justin referenced power purchase agreements. When you bring back one of these reactors because a hyperscaler wants your offtake from that electricity production, none of them have done it on speculation. It's already been paid for. So you're bringing a reactor back online because you were paid to bring that reactor back online, and you're going to make money bringing that reactor back online. It's no different than capacity in uranium. If I'm a uranium producer and I have capacity sitting in the ground, I'll happily bring it back online to meet your needs, but you have to pay me for that at a fair price that's going to make me and my shareholders, the company and shareholders profits. That's where there's a disconnect, and that's what time will tell what they're going to pay for that. Unfortunately, Justin referenced earlier, he said, 5 years isn't that long. That's tomorrow in mining, right? So there seems to be a belief that the uranium, as one fuel buyer told me recently at a conference, I was talking with him. He said, I get it. Yeah, shortages, but the uranium ferry always delivers uranium. They haven't in the last move from mid-20s to mid-80s. Where's that uranium ferry? So.
Yeah, excellent thoughts from both of you. I do want to talk about the volatility we've been experiencing in the sector recently. Mike, you alluded that that's basically kind of par for the course and more narrative than the actual reality that people should be focused on, which is the supply deficit. But we have seen some pretty tremendous days, both up and down, double digits at time. Obviously, this sets Uranium X on fire with either jubilation or despondency. So that's always fun for some entertainment. But if we look at URNM since the end of September, it's basically been a roller coaster. What do you think the reason for this extreme volatility recently has been? Is this just par for the course? Justin, I'll go to you on this one first.
I mean, if you look back at the last 5, 6 years, there's huge volatility in the sector. That's nothing new. So to see a 20-25% pullback in the last 3 weeks for the ETFs, that feels big. Historically speaking, that's really kind of not a big deal at all. The volatility really, I would say recently, has been driven by a few things. One, I would say that a lot of the moves we've seen across the sector have been headline driven and capital flowing into spot driven. So we've seen the spot price kind of tick up and pull back down a few times based on spot buying. Like I mentioned, 475 million came into spot since mid-August. It's an enormous amount of money. That's following a $200 million private placement. So all in all, spot has raised $675 million in the last 5 months. It's a lot of money. So we've seen institutional interest definitely step back into the sector. That's been driving things a bit. We've also seen just kind of like a meme stock mania. So in one example, URA, Oklo was almost 20% of URA going back 4 or 5 weeks ago. And that was a stock that was actively being driven by Wall Street Bets, which has 27 million members. So they just see a stock that can be squeezed, that's highly liquid, they go after it. And then so we literally saw Oklo, and then after the Westinghouse investment from the US government, news came out, Cameco as well, almost 20% of URA. Those two stocks are kind of pulling up URA. You have that flywheel happen, and the whole sector's kind of moving up based on a couple of headlines and based on a meme stock. So for us, that was a signal that the sector was getting overheated, especially when we're looking at the physical market at the same time and seeing that it's stable, and we're liking what we're seeing here because we're seeing utilities actually step into the spot market and carry trades get done, $75, $76, $77 a pound. That floor was mid-60s 6 months ago. So that's how quickly the physical market has actually moved up, and it's happening quietly in the background because everybody looks at the spot price only and they see, well, the December 31st print was $75 and here we are at 76.50. Big deal. But if you look at what's happening, the effective floor in the spot market has moved up pretty substantially. Back to the equities volatility, that's just how this sector rolls. If you have a long-term bullish bias, which we do, it's a very tradable market. You're going to have things move way higher to the upside than you expected, which they did. We expected recovery from the troughs in April. We didn't expect things to triple, for example. So they went higher than we expected. Will the pullback go steeper than expected? They usually do. I don't know where this pullback's going to end. Probably largely going to be dictated by the broad market since the physical market is a little bit quiet, but all of the elements are there. So we like to try to benefit from that volatility, but when you know what's driving the volatility, that's so much more helpful. And Mike and his team, of course, knew this back in Q1, Q2, is like the market was being pushed down by some narratives that were utterly absurd. You had these pod shops and kind of these funds with these factor baskets that were kind of like AI adjacent uranium. And their number one take was Sput's going to have to sell 50,000 pounds to keep the lights on. Let's short the shit out of the sector, pardon my French. And that literally, then you had this momentum of terrible sentiment and retail throwing in the towel, publicly capitulating. And we could see that was happening, and it hurt. Okay, it was not fun to experience it, but when you know what's driving it, it makes it more tradable. And the same thing happens on the upside that we saw, a few weeks back. So tradable market, fundamentals intact, long-term bullish bias makes that volatility easier to stomach, and makes it easier to actually benefit from it.
And Mike, your thoughts, and also this connection between AI and uranium equities, which I think is extraordinarily erroneous. We obviously saw when DeepSeek came out, there was a big sell-off in the uranium sector. A lot of people attributed that to people panic selling because there wasn't going to be all this energy demand by AI data centers because China had somehow mastered this very low energy, low capital cost form of artificial intelligence. But for those who follow the sector, that's not even a part of the thesis, right?
Jesse, it's just not even, I mean, it's on my radar because I'm breathing and I look at the markets. But in terms of, supply demand for uranium, what's going to move uranium pricing, it's just not. But it is unbelievable the correlation that you see when AI names are getting hammered, they get hammered. And like Justin said, the weightings and the ETFs and some of the baskets at the investment banks, they put together baskets, right? It's an easy way to do it. Hey, buy this basket and boom. So as a uranium upstream investor, we get to deal with all of that exciting volatility for stuff that we're not even that focused on. The same thing with SMRs. I have no idea if the SMR things are going to work. I actually don't care because it's not factoring into our supply demand analysis. And I'm definitely not smart enough to figure out which technology is good or not. So since 2018, 2017, our focus is on what's it cost to pull this stuff out of the ground that makes the big reactors go, and is there enough of it or not? And the volatility that gets attached just to that simple fourth grade math problem, supply demand of uranium, the noise that surrounds that is unbelievable. And it's tricky.
So
it's tricky if you allow yourself to get whipped around and don't have.
Yeah.
I mean, if you're an investor that's a casual tourist in this space, I'm very, very rarely on X. But if I hop into it for something and I'll see people saying, "I hate this trade. I've been investing in uranium since 2018. I haven't made a dime." It's like, how? Unless you're selling at the bottom of these pullbacks and buying at the top of the moves. So.
Yeah, they're YOLOing into explorers and all this stuff. That's people want the 100 baggers. That is generally those types of people. My final question also relates to AI, because a scenario that I could see unfolding ahead is perhaps many people believe that AI is in a bubble at present and all of these companies are tremendously overvalued, that AI really is not going to change the world. and become super intelligent and replace all the jobs and do all these things. We've particularly seen issues with OpenAI now, requesting government backstops and essentially handouts from the government to ensure that they don't fail. And then Sam Altman writing a novel on X, basically trying to explain away his position. But my concern, I guess, in the short term, is that if we do see a massive bursting of the AI bubble and all of these companies crash tremendously, considering the correlation we've currently seen, as you noted, between uranium equities and AI, do you think that could lead to a massive sell-off in the uranium sector and thus perhaps be an incredible buying opportunity for those who really understand the thesis? Justin?
Well, I think considering the historical limited breadth in the broad market and all of the Mag 7 stocks having at least something to do with the AI story, AI narrative, for that bubble to pop is going to bring all markets down. I don't think that would be unique to uranium. With that said, it's obvious that the uranium story has been at least somewhat tied to the AI story at times. So I would not be surprised to see, and we saw this in the last 12 to 18 months, and on the way up and on the way down, especially last year when the AI story really started to hit and the restart of 3 Mile Island and all of that. We saw uranium get dumped after DeepSeek, which was utterly absurd. The narrative made no sense whatsoever, but it did happen. So I don't think your potential concern is really all that far-fetched. I think it certainly could happen. I would say any correlation that we have to the broad market and or AI quote unquote bubble popping, if we see downside from an event like that, that would be an enormous buy the dip opportunity, because this sector really has its own fundamentals driving it, and we're extremely confident in where it's headed in the mid to the long term. So yeah, that's kind of where I see that.
And Mike, I assume you share similar sentiments, but would love to get your thoughts as well.
Yeah, Jesse, I do. I think so many things are correlated. I think people shoot first and ask questions later. They panic and sell, and nuclear AI, as long as the basket's at the big banks. And, what you don't see is that there's a lot of capital coming into the space from institutions. And there's very few ways to express the view. If you were just looking at uranium and you're a multi-billion-dollar fund, you're, okay, I got one stock I could buy. That's going to matter. So they branch out and they look for anything that could be attached to it. And it has tentacles. And so if the AI bubble pops, yeah, you would probably get a pretty good further pullback. And again, if you're focused on the fundamentals, then that would be, jump up and down, pound the table, buy these things.
Well, gentlemen, this has been a fantastic discussion. Justin, tell us about Uranium Insider.
It's a newsletter service we've been running since August of 2019, and I've got a dedicated team behind me. We focus 100% on the uranium sector, put a lot of effort and energy into understanding the physical market, trying to whittle down the enormously complex elements of this industry into what matters for investors. And despite the fact that we're 6 years in, we see a pretty long runway here. Like I mentioned earlier, I really don't know where the supply is going to come from on a 5-year runway, let's say, to set this sector turning in the other direction, as all commodities eventually will cycle down. I don't know where that's going to come from. I literally don't know where it's going to come from. And higher prices are incoming in the meantime. So yeah, uraniuminsider.com is our website. Decently active on X at Uranium Insider.
Great. I'll put links to both in the description below. Mike, I know you don't have much of a public facing profile or a lot of, or anything to sell really. But would love maybe if you could just shed a little bit of light on Sachem Cove and your strategy behind investing in the uranium sector, as much as you can reveal.
Sure. Sachem Cove is Sachem Cove Special Opportunities Fund. Is a vehicle that invests in uranium, and the investment manager is Lloyd Harbor Capital Management. Sometimes people get confused. That's the manager of the fund, so we have been in uranium equities and physical uranium for many years. We started doing our work in 16, 17, and started expressing the view in 2018. Also have a look at other vehicles that has look another vehicle that looks at similarly depressed industries where very deeply cyclical, where commodities have been crushed, the equity prices have been crushed, and the market has been left for dead. And you can find, industries like that, sometimes hiding in plain sight, sometimes not. But we are, we're uranium focused, and it's a crazy market, but it's addicting. I will say that, as Justin will attest to. It's that's what we do. Keep a very low profile. I do this and one or two others a year. I don't have the temperament for X, and I don't have the patience for it. So a lot of smart people on there. I find for me it just takes a little bit too much of my time and energy. So
Yeah, I totally get it. I'll put a link to Sachem Cove. Obviously, your institutional investors are who you generally deal with. A lot of different type of people watch this show. If you're an institution, go ahead and reach out to Mike. And thank you so much, guys, for coming on. This has been a blast.
Yeah, thank you, Jesse. Always fun to chat with you and Justin.
Thanks, Jesse. Really appreciate having me on.